First up, we will be discussing supply. So, here are some of the basic concepts of supply. Supply, in essence, is the amount of goods and services, or the goods and services that are produced for consumption, or things that are produced that can be demanded. This has to do with, there's also the law of supply, which is the higher the price, the higher the quantity supplied. There's essentially a positive relationship between quantity supplied and price. Here are some of the causes of shifts in the supply curve. One is competition in the market between sellers. This can be either the amount of sellers or the prices they offer. For example, if there are a lot of sellers, that means the supply is going to go up in general, but the individual supply of each seller might decrease a little bit. Number 2 would be the level of technology used. For example, if there are improvements in abilities to manufacture certain goods, obviously the supply will increase. Number 3 is the price of inputs. If input costs go down, then more goods and services will be able to be produced that will increase the supply. Number 4 is government regulation or taxes. This will be discussed in the following slide. Number 5 is expectations of future prices. For example, if the manufacturer of gloves believes that prices will go up for gloves in the future, they're going to reduce manufacturing now in order to be able to supply more in the future. Now, government intervention. This can be done in various ways. One way is a price ceiling, which is the highest price a good can be sold at. This is usually used to lower the price of goods. Price floors are the lowest price a good can be sold at, and these are used conversely to increase the price of goods. Taxes have an indirect effect, with an increase in taxes affecting input costs. So an increase in taxes is going to also increase input costs, which is going to reduce the supply curve, which means it'll shift to the left. Now, for the effects on equilibrium. When supply increases, the curve will shift to the right, and the equilibrium price decreases while the quantity increases. When supply decreases, the curve shifts to the left, and equilibrium price increases and quantity decreases.
Is demand. We're going to go over basic concepts, things that cause shifts, and government intervention. So the law of demand says that there's an inverse relationship between price and quantity demanded. Quantity demanded is basically how much people want of something. Things that can cause shifts in demand are taste and preferences. So, for example, if scientists say dark chocolate is healthy, then demand for dark chocolate will increase. Related goods can also cause shifts. So, for example, if a certain good has a price that rises exponentially, then its complement will also have lower demand because the higher price. Income of consumer also matters because usually higher income means higher demand. Population is also higher population equals higher demand, and expectations of future prices can also affect demand. If demand increases, then the equilibrium price and quantity both increase, and if the demand decreases, then equilibrium price and quantity both decrease. The government can affect demand of a certain good or service through many ways, through taxes or other means. For example, if the government makes it difficult to acquire cigarettes, like putting them in a closed case, for example, and puts up promotional videos against cigarettes, then the demand for cigarettes will go down. Furthermore, if the government implements a high cigarette tax, then the demand for cigarettes will also go down.
Supply and demand both increase. Then the equilibrium quantity increases and change in price is ambiguous. When supply and demand both decrease, then the equilibrium quantity decreases and the changes in price are ambiguous. When supply increases and demand decreases, then the price level decreases, changes in quantity are ambiguous. When supply decreases and demand increases, then the price level increases, changes in quantity are ambiguous. Shortage and surplus of goods. So the shortage of a good is when the quantity of a good or service demanded exceeds the quantity supplied, and it occurs when the price is below equivalent level. The surplus of goods is when the quantity supplied of a good or service exceeds the quantity demanded, and it occurs when the price is above equivalence level. The types of goods include normal goods, inferior goods, complements, and substitutes. Normal goods are when the increase in income leads to an increase in demand for these goods. These are usually more luxurious services or goods, for example, sushi. And inferior goods are when an increase in income leads to a decrease in demand for these goods, which also means that a decrease in income will lead to an increase in demand for these goods, like ramen. Complements are two goods that are often consumed together, where when the price of one rises, then the demand for the other one will decrease. For example, hot dogs and ketchup. Substitute goods are two goods in which a rise in price of one good leads to an increase in demand for the other one, like Pepsi and Coke.
This is part 3, which is currency exchange. We're going to talk about exchange rate and things that cause shifts. So appreciation is when the value of a currency increases. If the dollar appreciates, then you can buy more euros with a dollar. That basically means that the dollar is worth more. Depreciation is when the value of the currency decreases. If the dollar depreciates, you can buy less euros with a dollar, so its value is worth less. The interest rate and exchange rate can all shift through various means. Money will always flow to the country with a higher interest rate. So if Denmark has an interest rate of 5% while the US only has an interest rate of 3%, people will take money out of America and put it into Denmark. This will cause the demand for the euro to go up, the supply of the euro to go down, and the euro will appreciate. So you can buy more dollars with the euro.
The fourth topic is balance of payments. Payments going in and out of a country. Basically, it's the difference in total value of a country's imports and exports, or a difference in total value between payments into and out of a country over a certain period of time. So there are two accounts. One is current account and the other one is financial account. The current account is the country's balance of payments of goods and services plus the net international transfer payments and factor income. On the other hand, financial account is the difference between a country's sales and purchases of assets to foreigners during a certain time period. So the current account equals the negative financial account. Thank you for watching.